Interest rates are most certainly going to go up, and that's clearly going to make the stock market crash. Do not get me wrong. I think that there is a big crash in the making. However, that is not the signal that I'm looking for. So many people in 2022 screamed the same thing about interest rates going up. And bear with me, look at these charts. But those people screaming about higher interest rates missed the entire bull market from 2023 to even present day. But here are some examples where that logic's reversed. I'm going to help you apply interest rates to your stock market predictions or forecasts. But here we have interest rates going down, went down the entire time of 2008. Interest rates going up, market going up. Here in the 2000s, when the stock market was crashing from the dot-com bubble, the entire time interest rates coming down, interest rates going up, market going up. And I can show you the inverse as well, where the rates were going up and the stock market's going down. Major problem is most people do not apply leads and lags to their interest rates, to their stock market predictions. We'll talk about future interest rates, but I say this every single FOMC, and I'm going to say it now before it comes up on the 29th. FOMC this month does not matter. Whatever the interest rates are on the 29th of July, which it's most likely going to stay the same, 66% chance, those interest rates were priced into the market 4 to 6 months ago. The stock market is a forward-looking discounting mechanism. That means that we care about federal interest rates for December of 2026. That is what is being priced in right now. It is likely why we have been so choppy since February, but that's when we first get our first spikes in federal interest rates. The probability is 38% for 400 to 425 basis points. It's looking like there will be 2 rate cuts by next year, okay? So we're seeing that is popping up to 425. And 2 more comments about federal interest rates, and then you can run off. But first of all, by the time the Federal Reserve starts cutting rates, it means that a problem is already happening. It takes time for them to recognize that a problem is happening and for them to adjust rates. And then it takes even more time for those interest rates to go out into our multi-trillion-dollar economy and actually have an effect. That's why we had those higher interest rates, but we didn't really see inflation come down because they weren't high enough and they weren't held on to for long enough because so many people were chanting for low interest rates, thinking that they were going to get a cheap home. Here is a little cheat sheet that will help you determine what interest rates are going to do to the market. If you say in approximately 6 months that the interest rates are speculated to go up, then it's most likely bearish. Again, that likely explains why the market has been so choppy since February, because it was discounting those future interest rate hikes. But I'm going to skip over this. Basically, if they're speculated to go down, that's bullish for the markets. But if interest rates are speculated to stay the same, again, 4 to 6 months into the future, and remember, we're going to be around that 400 basis points. It's speculated to be 2 interest rate hikes by the next year, okay, this time next year. So it's stability. We care about interest rate stability. The stock market will likely be choppy and bullish at that time. Yes, you will have intraday volatility from the day trading FOMC gurus, but overall, these interest rates, if you start applying 6-month lead on them, you're going to have far more accurate stock market predictions.